Well, kia ora, everybody. Welcome to Shared Lunch, brought to you by Sharesies with BusinessDesk. My name's Patrick Smelly. I'm the managing editor at BusinessDesk. We have a great BusinessDesk special to offer for listeners and viewers, and you can find out about that at the end of this episode. Before we get started, here's some important information.
Investing involves risk. You might lose the money you start with. We recommend talking to a licensed financial advisor. We also recommend reading product disclosure documents before deciding to invest. Everything you're about to see and hear is current at the time of recording.
Today we're talking China. We're joined by David Skilling, a New Zealander now based in the Netherlands, director of Landfall Strategy Group and a commentator on global economics, geopolitics and economic policy from a small economy perspective. Good morning, or in your case, good evening, David.
Good evening.
Let's start with a bit of context. Help us to think about how important China is as a trading partner for New Zealand.
By a significant margin, it is our most important export market. It's a bit over a third of our goods exports, and prior to COVID, it was also a pretty significant tourism market as well. It's the second largest tourism market. Then on the import side as well, we're getting about 20 billion a year in terms of imports. So, going back 20 years, China was not nearly as significant. The last 15, 20 years, China has roared ahead, as it has for many other economies around the world. China has become the second largest economy in the world. Voracious import demand. New Zealand sells a lot of commodities, dairy, forestry, fruit, fish, as well as tourism. And as with many other countries, we import electronics, textiles, a whole range of things. So China is dominant. And you've got to go back quite a long way in New Zealand's economic history before you reach a dependency that's as significant as China has become for us.
And how do you see that developing over the next, say, 4 to 5 to 10 years?
Well, from an economic perspective, it's likely to keep on growing, not quite at the rate that we've seen over the last decade, which largely speaks to the fact that China's overall economic growth is going to be less strong, but it has been. The forecast for the next several years are about 5% GDP growth on average. That's significantly down from the high single-digit growth that China was growing at, so that's going to have an impact on import demand. So still a large market, still growing reasonably quickly compared to other export partners, but it's not going to be as strong. And I think the additional complication over and above that kind of more modest, if you like, rate of economic growth is that geopolitics is going to intrude, as it has for other countries. Look across the Tasman with Australia, the US, obviously. There are a whole range of frictions in terms of doing trade with China. New Zealand's been implicated in that a couple of times, but on a pretty sort of small scale kind of a way. But I think we can expect those kind of political frictions to become more meaningful over the next sort of 5-10 years. So both some economic headwinds, but also I think some political risks. So China will continue to grow, but it's not going to be, I guess, the golden weather that we've enjoyed over the last 10-15 years.
We'll come to geopolitics and China's place in the world in a moment, but just for a Sharesies audience, who or which listed companies have most exposure in China these days, New Zealand listed companies?
Well, then obviously, one of our larger export categories to China are commodities, and many of those are in the non-listed space. Meat, kiwi fruit, so they're kind of not. Fonterra is in part, obviously. But there are some, the fisheries companies, Sealord and the like, do have some exposure, some significant exposure to China. And in the tourism space, obviously, which is not so big at the moment because of the pandemic recovery, from THL, Air New Zealand, Auckland Airport, and the like have significant exposure, as does companies like Sky City. But I think beyond companies that have direct exposures to the Chinese market, the reality is the New Zealand economy as a whole is dependent on the health of the Chinese economy. So if the Chinese economy slows down, this export growth, that's going to percolate across the entire economy. So, yes, there are companies that have particular exposures to China, but New Zealand also just, as an overall economy, has become pretty exposed.
Yeah. So if I think to life before COVID and life after COVID and China before COVID and after COVID, it feels to me as if China has emerged from the COVID experience quite a different looking international player. It may not be because of COVID that that's happened, but that in a way a line got drawn somewhere there. How should we, or how do you look at China today compared to how we might have looked at China, say, 2018, 2017?
Well, I think the pandemic, coupled obviously with the consequences of Russian invasion of Ukraine and China's stance in that, and the Western sanctioning of Russia, those events have kind of crystallized, I suppose, some dynamics that have been in the works for some time. So the pandemic, the fact that China was closed, there have been very few kind of people-to-people movements in and out of China because their borders have been effectively closed. China has become a more closed economy in terms of both economic flows. It's become more distant politically. But those effects have been, or those dynamics have been underway for some time. And President Xi has been in power now. We just moved into his third term, so he's been in power for 10 years. And over that course, China has set quite a different posture in terms of its relationships with the world. It's become a lot more assertive internationally, a lot more oppressive internally. The nature of its economic policy has shifted as well. And so I think the West, which for the longest time since China's emergence from the 80s and 90s, thought that it could engage with China economically, and that over time there'd be some process of China becoming more like the West. There's a realization that that's really not the case. China's pursuing its own path that is in a way in opposition to Western values and Western norms. And so I think China has certainly shifted in terms of it, a much more assertive country, much more inward-looking, much more prepared to say, look, we're the second largest economy in the world, to a point the largest country by population in the world, and we want to reshape the system. I think the West has also, particularly the US, has realized that China is also a different animal than it thought that it was, and has begun to respond with various sanctions, restrictions, pushing back, trying to contain China. So I think China has shifted. And I think the other dynamic is that the response of the US, and to a lesser extent, Europe, Japan, South Korea and the like, have also begun to respond. So we're in a much more competitive, rivalrous system than we thought. As you say, even going into the pandemic, the world kind of looked and felt different. It's not because of the pandemic, but I think the pandemic, coupled with the Russian invasion of Ukraine and all the aftermath of that, it has really crystallized something that is quite different. And if you horizon the next 5, 10, 20 years, the world we're moving into is quite dissimilar than the world we've enjoyed over the last 10 or 20 years.
There's a sort of a dissonance there, though, for me, in the sense that on the one hand, we can see all of that happening, that departure of values, the recognition now that China is not suddenly going to become a democracy as a result of liberalizing its economy and trading more. But at the same time, is it not fair to expect that all of these more disputatious partners in the global trading environment anyway are still going to want to trade with one another? It seems to me that the United States, Europe and China are very much joined at the hip from a trade perspective, even if they're not in the course of disjoining when it comes to their view of how the world political environment should develop.
No, I think it's a fair point. And my very strong conviction is that globalization is not reversing, it's not unwinding. It's very hard to put the genie back in the bottle. Global flows that have grown enormously strongly over the last several decades for very good reason. Now, geopolitical frictions are going to emerge. There are going to be restrictions and constraints and limitations on the path of trade. But if you look at US-China bilateral trade flows, they're sitting at pretty close to record levels. So despite the tariffs and the trade wars under Mr. Trump, and now an even more aggressive set of policies under President Biden, US-China trade flows are still very, very strong. Similarly, if you look at European investment into China, also sitting at record levels. So if you look at where the geopolitical friction is happening, at the moment at least, it's in fairly contained areas around semiconductors, other advanced technologies, and other forms of sensitive goods. There's increasing capital restrictions. I think there is going to be a widening of that footprint in terms of what is constrained and limited, but we're not going to see a complete decoupling. Miss von der Leyen, the EU Commissioner, gave a speech last week where she talked about it's not about decoupling, it's about de-risking. Right, so Europe is much more exposed to China than is the US. The US is actually a fairly closed economy. Europe is not. It's got very significant exposure to China. It can't realistically decouple. It's incredibly dependent on China, both for commodities, a range of technologies, a whole raft of things. But it does need to be much more intelligent about how it manages those exposures. It's learned, I suppose, a lesson from Russia. You become overly dependent on what is essentially a strategic rivalry, a rival for, in Russia's case, energy, you open yourself up to vulnerabilities. And the concern is that China might be a repeat of that. So I think there is an active process of figuring out which economic exposures are mutually beneficial. Do we want to continue? Which create undue vulnerabilities and do we want to manage? Of course, that's not all up to us. China, for its part, is doing roughly the same thing. It doesn't want to become overly reliant on the US, on Europe, on others for technology, for energy, for food. It's also trying to become more self-sufficient. So you're right, things are not going to decouple. We're not going to see a complete reversal of global flows, but we are seeing more frictions, more restraints, and I expect the direction of travel over the next 10, 20 years is for more of that. So it's not going to be a binary proposition. It's not going to be like the Cold War, where you have two completely different blocks, but it is going to be a much more challenging environment.
So how do you expect that New Zealand companies which are trading with China would thread their way through that? Are we looking at a situation really where if you're selling food or fibre or soft commodities, you're going to be in reasonable shape because there's no technological component to that necessarily, but plenty of demand from the Chinese population, whereas the sense I have is that technology, we're going to end up choosing Western technology over Chinese technology. Where are the opportunities for New Zealand firms in this, and where are there going to be inevitable pitfalls?
So I think, as you say, New Zealand's footprint in largely the soft commodity space, when yes, there are some tech firms and others, but largely in the soft commodity space, does mean that we're not, those companies are not immediately in the firing line. China does want to buy our dairy, our fruit, our wood, and the like. We're not immediately exposed to that. But at the same time, China is looking to increase its self-sufficiency in areas of its economy that regards as strategic, of which food is one. So if you look at the investments that China is making, both in self-sufficiency, but also in technology around food, be it precision fermentation, vertical farming, and the like, it's not that the food is completely without substitutes. So it's not, let's say, directly in the firing line, but also I wouldn't say it's completely without risk. I would also say, in terms of China's import portfolio, the countries from whom China is conducting trade, it is looking to, over time, rebalance that portfolio towards countries that it regards as friendly. Now, New Zealand has had at least among Western-leaning countries, one of the more constructive relationships with China. China regards New Zealand as one of the the role models, if you like, of how Western countries should conduct diplomacy with China. But I expect that's going to become a much more difficult path to tread for New Zealand. And we're going to have to make some choices as a country in terms of, what's our orientation? Are we more Western-leaning or not? And China does have options. We're not the only country that sells fish or fruit or wood. Our stuff is particularly good, but China does have some options. And so I think there are going to be some frictions. And even though we're not in the high-tech space, yet neither is that export profile without risk, both for geopolitical reasons, but also because China is just looking to move to a position of greater self-sufficiency.
Yeah, well, we'll come back to that. What is our relationship with China in a little while? One of the most interesting, I suppose, indications of this friction at a global level in recent times has been the extraordinary spectacle of the congressional hearings relating to TikTok. What do you think we're watching there, technologically and politically?
Well, look, I don't know the ins and outs technically of the of TikTok in terms of how much genuine privacy issues there are. My overall takeaway from that was that the congressional hearings were a real spectacle of the bipartisan consensus on China. Similarly with the spy balloons that floated over the US, a couple of months ago. Be a Republican or Democrat, it's very hard to find much daylight between the two in terms of China as a threat, China as a rival. The center of gravity on China has shifted enormously.
Is it also, and this is a question with an investor's frame of mind, also a more inflationary world? We're now living in a world in which we're back to high interest rates. We seem to have inflation difficult to tame in many parts of the world, and to the extent that, I take your point that globalization is not completely unwinding, but if we're going to see a lot more trade and technological transfer, which happens between friends and allies rather than across borders, irrespective of political orientation. It just feels to me as if that inevitably implies shorter supply chains, less competition, more inflationary conditions, possibly slower global growth as a result.
I think that's exactly right. So the framing that I use is that we're moving into a wartime economy, not a physical war, but kind of war by other means. So we're using economic instruments to prosecute a war. And if you look back through history, periods of war, both cold and hot, are inflationary. And I think many of the conditions that we have enjoyed from an investing perspective, from an economic perspective over the last 30 years, vast expansion of the global labor supply, huge growth in global supply chains, enormous efficiencies, fantastic demographics, new technology. Many of those forces are either unwinding or weakening. We're having a contraction of the global labor supply force. We're having compression of global supply chains, increasing geopolitical and economic frictions on global flows. There's a whole raft of things that are going to be inflationary in nature. So central banks, in a sense, had not an easy job, but a reasonably straightforward job in terms of reducing inflation over the last 20 or 30 years. It's going to be a much, much more difficult job going forward to get inflation down to what we have regarded as target, 2-3%. So, once we get through this kind of near-term volatility in terms of how quickly it takes to get inflation down from its current heights, I think trend inflation in a 3 to 4% range is more likely than not. So I think we're moving into quite a different world with higher inflation on average, which puts pressure on firm margins, puts pressure on household budgets. And I think from a central banking perspective, the issue then becomes, what sort of inflation level should we be targeting? Is it realistic to get inflation down to 2% in a world that is structurally different than the world over the last 30 years? I think the answer to that is probably no, at least not at an acceptable economic or political cost. So I think the way in which central banks conduct their business is going to be really quite different than how it has been over the last 20 years.
So, I mean, that all sounds fairly gloomy from an investor's perspective. There must, though, be some opportunity that arises out of all of that. Is there opportunity potentially, unfortunate as it may be, if you take a sort of a pro-trade liberalisation view of the world in redeveloping some of the muscle memory that we've probably lost from the 1970s and 80s as to how to operate in a world that's more protectionist?
Yeah, so there are opportunities. I think I'd make a couple of points. One is that I think we're going to be operating in a fairly high-pressure economy. So government spending is going to be structurally expansionary for many reasons: industrial policy, military spending, transfer spending. I think government balance sheets are going to be much more aggressively used than has been the case. I think that's going to provide, if you like, a baseline, a floor
so
for economic activity.
Big government's back for good, in a sense.
Yeah, it's the return of a state. I think some of the norms over the last 30 years in terms of reducing the size of government, were appropriate for a world in which we're enjoying the post-Cold War peace dividend and globalization was proceeding and the like. That's not the world that we're in anymore. The calls on government are expanding, so military budgets, but also partly in response to more protectionist tendencies. Governments are looking to strengthen their industrial bases, be that energy, be that semiconductors. You see that within the US, you see that within Europe, you see that within China. Less so obviously in economies of scale of New Zealand, where we can remain reliant on supply chains. But we're seeing a boom in capex in many of these large economies as they try and rebuild industrial bases that have been, in a sense, hollowed out as they've relied on global supply chains. There's a reshoring or a nearshoring of economic activity. I think in terms of sectors, obviously the net zero transition, green energy, referring from hydrogen to batteries to electric vehicles, is going to be an enormous growth area. I think there's many areas of technology, particularly St. Goldman's put out a report on the economic impact of artificial intelligence last week, very significant numbers. So I think, we're in a world where the pace of technology is going to continue to grow and to accelerate. I think we're going to see significant amounts of capex going into strategic areas of the economy. Again, it's everything from energy to bits of tech to industrial base more broadly. And as you say, within individual economies, there are going to be bits of economic activity that are brought closer to home because we don't want to run the risk of, sort of fragility in our supply chain. So I think you put all that together, high pressure economy, reshoring, technology, and I think there is a bunch of, from an investor point of view, there are actually a bunch of opportunities out there. So although I'm somewhat gloomy in the sense, I think it's a much more challenged and complex global economic and political environment, I don't think that necessarily is bad for growth or bad for investors. It just means you've got to interpret and navigate a slightly more complex set of factors in a more benign environment we've seen over the last 30 years or so.
Let's talk a bit about the Chinese economy itself. What's your sense of how the Chinese economy is coming back from COVID? How much can we trust what we're seeing from China? I mean, I've talked to lots of economists who say you shouldn't believe any of the numbers that come out of the Chinese statistics department, and it appears to be going quite smoothly for a country which stayed locked down in such a fearful state for such a long time. What do you think is really happening there?
Well, I mean, the Chinese economy, ground to a standstill at the end of last year as they kind of removed the various restrictions, and it was all very messy and a bit chaotic. But it's now into Q1 of this year, and now Q2, it's recovering very, very strongly. Things are reopening. It's doing so at pace. All of the available economic data, across a range of indicators look reasonably positive. At least domestically, the export side is struggling a little bit, but in general, the Chinese economy is rebounding very strongly. But I think the point that I made earlier in this conversation, which is that the trend rate of growth, the target for the Chinese government is about 5% this year. The IMF think 5% growth for the next few years is likely. That is 2-3 percentage points lower than what we were seeing in the years prior to COVID. So still 5% is pretty good, certainly good compared to other advanced economies.
That slowing was occurring anyway, though, wasn't it? I mean, it was almost an artifact of the fact that China has grown so much that it was inevitably going to come to a point where it began to grow a bit more like a sort of a partially advanced economy. How much of this is about that, and how much of this is about some fundamental change in the relationship between China and the rest of the world?
Well, I don't think too much of it is due to a fundamental shift because, at the moment, outside of a few specific sectors like semiconductors and the like, those effects haven't become enormously material. I think they will over time, but so far they're not. I mean, even the Trump tariffs, weren't enormously consequential for the Chinese macro position. And I think China is more developed, and so the pace of convergence is going to slow. But I think also China's just reaching some limits based on the nature of its growth model. Huge capital misallocation, huge overhang in terms of property market. It's now running into an issue where its working age population, its overall population, is beginning to contract. Last year was the first year in China where deaths exceeded births. Now, partly that was COVID, but more generally, if you look at the demographic projections for the next several decades, China's population is going to contract very, very sharply over the next little while. So that's going to drag on growth. And also, China is becoming a more inward-looking economy. So you can talk about headline GDP growth, which, as you say, is not always the most reliable measure. But from an external party perspective, the interesting metric is import demand. How much does China want to consume of foreign goods and services? And import demand is not growing as strongly as it was. And with a contracting population, that import demand is going to be more constrained. And with China looking to become more self-sufficient, it's another set of constraints. So I think China is rebounding. It's doing so quite quickly. But China is not going to be growing at anything close to rates that we saw prior to the pandemic. And there are some, I think, very, very meaningful headwinds. Demographics, I think, are the most consequential of them over the next few decades. China's population growth is unwinding very quickly.
So should we expect then, again, from a New Zealand firm's perspective, two of the implications of that would seem to be that Chinese demand for protein and fibre, the things that we send, milk and other stuff, wood and related products, and also demand for tourism and possibly for education in New Zealand, which was also a very big part of our relationship with China prior to COVID. Does that naturally shrink?
It's going to grow less rapidly, I think, is kind of the lower risk way of putting that. I mean, I think for some segments of the markets, you think about infant formula, for example, that, if you just look at the demographic projections, the market size of, kids aged 0 to 4 is going to start reducing quite quickly over the next few years. So if you're exposed to infant formula, that's not a high growth part of the market. In China, despite the fact that it's not going to be as large, it's still a significantly sized market. There's still lots of people who want to travel, for tourism and other reasons. But I think, the linear extrapolations that we saw in terms of we can just expect China to be the gift that keeps on giving, I don't think that's right. And there are going to be constraints. And I think additionally, there are going to be more, the nature of Chinese demand is going to be shaped to a much greater extent by political factors. And we've seen that, you take tourism, which seems to be a fairly non-political space to be in. China commonly uses political messaging to influence where Chinese tourists go. Japan was off limits for a while, South Korea off limits for a while. It doesn't take too much of a leap of imagination to think about New Zealand or Australia, for that matter, as being a country that you might not want to visit compared to Southeast Asian markets, for example. So I think there will be growth. Chinese tourists are beginning to travel again as borders begin to reopen de facto. But again, I think there's a real question mark about whether we'll see the volumes of Chinese tourists coming into the New Zealand market, as well as Australia and others, of a type that we've seen previously. I think we should be much less bullish than we have historically been.
Yeah. You touched briefly on financial stability and the stability of the Chinese banking system, property markets. I've kind of lost track of how to think about that. At one stage, it all looked terribly dangerous. And then more recently, I saw a bunch of headlines which suggested that maybe they had the property bubble under control and were lending back into that sector. Can you just kind of give us a thumbnail of what's happening there and how much we should be concerned about the possibility that China actually has its own banking bubble to deal with yet?
Well, I think the fundamental or structural issues with the Chinese real estate sector are vast and have been underway for some time. There's a huge imbalance between demand and supply. But the nature of the Chinese system, as distinct from the US or European or Australasian system, is that the Chinese government has many, many more policy instruments to kind of deal with that. So I think it's very unlikely, at least in my assessment, that we see kind of a global financial crisis style kind of property bubble imploding and kind of contaminating the rest of the economy. What I think is much more likely is we see a gradual deflation of a balloon, if you like, that is going to act as an ongoing drag on the economy because you have to get rid of this debt and this overcapacity somehow. But I don't anticipate that we're going to see a kind of a big bang type of financial crisis. I mean, the Chinese government wouldn't allow it. They will do what it takes. It's kind of too big to fail. But it is going to act as a drag on GDP growth and on productivity. So it's something to watch, but it's more of a slow leak, if you like, than I think than a car crash.
Let's just turn to the New Zealand-China relationship. There's been a lot of focus in the last few weeks on the fact that the Australian government has decided to commit to both buying and building nuclear submarines in the so-called AUKUS pact with the United States and the United Kingdom. A lot of conversation about whether New Zealand should in some way join this pact, despite the fact that we presumably are never going to be in a position to actually build or buy our own nuclear submarine, let alone operate one in our territorial waters, given the anti-nuclear policy. But it has led to conversations I've had recently with people saying, how should we regard China? Is China the enemy now?
Yeah, so I think enemy is not the right word. China is not enemy. We're not at war with China. But I think, as with other, peer countries, Europe perhaps most obviously, China is a strategic rival. It wants the world to be organized in a different way than I think we would like. It conducts itself differently. Our interests don't always coincide. In some areas, obviously, they do. China is our most significant trading partner. We have a lot in common. We like in China's involvement in things like solving global climate change. It remains absolutely pivotal. So as with many other countries in the world, there are a range of issues on which we need Chinese collaboration. We need to ensure ongoing good relations, and New Zealand should strive to do so. But China is also acting in ways that make it difficult for New Zealand to do that in all situations and in all times. And I think we're moving into a world where it's very hard for New Zealand to have it all ways or have it both ways. I mean, we pride ourselves on being independent, to running an independent foreign policy. But that doesn't mean that we can just dodge all choices. And choices will be required of us.
So it's always seemed to me as if New Zealand has relatively successfully played soft cop to Australia's hard cop or the American hard cop. The Chinese do place value in the relationship that exists with New Zealand, which has, there's a bunch of things they refer to as the four firsts, first things that New Zealand did first with China before anybody else. Perhaps less important today than they were in the past in the development of the relationship. But it's also struck me that being the soft cop isn't necessarily the worst place for a country like New Zealand to be. But do you think we can continue to play that role credibly? Is it an appropriate role for us to try to play?
So, I think New Zealand has played its hand reasonably well. Over the last, let's say, 10 or 20 years, we have been, to use your words, kind of sort of good cop, as opposed to Australia's bad cop. There is obviously daylight between our respective stances on China, and I think if anything that has kind of helped New Zealand economically in other dimensions as well. But I think not wanting to make choices doesn't mean that we don't have to make choices. I mean, we would like not to have to make choices. We would like to maintain the status quo. I'm just not persuaded that's an option that's going to be available to us for too much longer. Both because I think China is acting in ways that make it much more difficult. I mean, if you think about China's behaviour in the Pacific, an area that we regard as of of some consequence. China and the Solomon Islands, China operating the Pacific Islands Forum. These are issues on which we care about, on which it's much more difficult for New Zealand to say we're not going to say anything too loudly. We actually have to assert ourselves, and that's going to bring us into conflict with China. So the surface area on which conflict is possible, I think, from a New Zealand perspective, is increasing as China comes closer to us physically, moving into the Pacific. I think we're also going to be under increasing pressure from countries like the US. I mentioned that the US was applying pressure to Europe to act in ways that it found a bit uncomfortable. The same is true for us as well. I mean, we would like not to make a choice, but if our allies are saying, actually, you have to, or you're going to be out of Five Eyes, or you're not going to have friends over here, then the option set we have available to us becomes much more constrained. And I think under the Biden administration, it's a souped-up version, or in a much more professional way, of the Trump administration. Very hawkish on China. And my sense was when Mr. Biden won the election, this is actually going to be very, very tricky for New Zealand, because more is going to be expected of us under Mr. Trump. We could kind of dismiss the trade wars and the anti-China sentiment as kind of psychodrama. It's kind of there, we'll just keep our heads down, wait it out. That's not the case anymore. Mr. Biden came in, consistency and policy direction, more professionally executed without the psychodrama. That's very, very hard for New Zealand to avoid. So we are going to be under more pressure to make some choices, not kind of a binary pro or anti-China or pro anti-US, but a series of choices which make it clear in which direction we're leaning. I mean, even on the Russia sanctions, it took us a little while to get ourselves organized, but eventually we did. And those kind of decisions are going to happen on a much more frequent basis. So yes, it doesn't mean we have to become a carbon copy of Australia or the US. We're going to do these things in our own way, but we can't sort of dodge these issues anymore. And we're going to have to take a much more hard-headed, realistic assessment of how we position ourselves. And I think, for me, I lived in Singapore for 11 years, so perhaps I'm a little bit biased. But Singapore is kind of right in the middle of this. It houses or hosts, American aircraft carriers, a lot of American kit, very pro-Western, lots of US multinationals, also very strong relations with China. It is constantly trying to balance. And to do that requires, seriousness, being hard-headed, accepting there are choices and trade-offs to be made. And I think New Zealand has to understand that these are very consequential choices. We can't avoid them. We need to be in the game.
It's a good point in the sense that we're not the only ones who have to do this as well. So we've ranged very widely across a bunch of issues. How would you summarize how an investor might think about the impact of China from a New Zealand perspective?
There are risks out there, but every time there are risks, there are some opportunities. So I think figuring out what are the ways in which New Zealand, US, Europe and others are responding to this increased threat from China. And as during the Cold War, with investment in technology, there were huge developments. So how do you position yourself to benefit from some of the silver linings, I suppose, from an otherwise cloudy outlook?
Do you think we'll see Chinese students back in New Zealand in large numbers in the way that we used to? And how do you see them as a contributor, either good or bad, to the way that the New Zealand-China relationship develops?
Well, I mean, it's been significant economically. I think also significant kind of culturally and politically. People-to-people flows are very important. I think it's going to take a little while for students to return, and tourists, I think, are going to come back with seasonality. I suppose they will start to come back. I mean, I think the other issue for New Zealand sort of attracting students from China is the quality of our universities compared to Australia and elsewhere. So we need to be able to make sure we can put together a strong value proposition. But I also think, again, some of these political factors are becoming more salient. So the extent to which China is messaging, you should be going to friendly countries. China is a less open economy than it was, pre-COVID and certainly 5 years ago. So again, I don't follow this super closely, but I would say there are some risks around the extent to which New Zealand can expect to get the same number of Chinese students coming in to New Zealand. Tourism is a bit exposed, but I would say less exposed. Students I worry about a little bit.
Well, thank you, David, for your observations and the depth of your knowledge and wisdom on this. If people wanted to find out more, do you have a Substack or?
I write weekly notes on these issues and others, davidskilling.substack.com. So if you want to follow me there, feel free to do so. That'd be super.
Thank you very much, everyone, for tuning in today, and thank you very much to David Skilling for staying up late at night and on the other side of the world to speak to us. We really appreciate your time and insights. Now, we also do have a special offer for Sharesies investors from BusinessDesk. If you use the promo code SharedLunch2023, you'll get $100 off the annual subscription to BusinessDesk. It's usually $249, including GST, so it's $149 if you use Shared Lunch 2023. The offer only applies to new BusinessDesk subscribers, can only be used once per subscriber, and can't be used with any other discounts. So please do avail yourself of that and enjoy the rest of the week and stay safe.